Sir, my bank account is earning almost nothing, but everyone keeps telling me to invest in mutual funds. What do they know that I don't?
They know that leaving money idle and making money work for you are two completely different financial strategies. The real difference between people who build wealth and people who constantly struggle financially is often not how much they earn, but how effectively they invest what they earn.
If that's true, then why do so many financial experts recommend mutual funds to beginners instead of encouraging them to pick individual stocks and try to earn bigger returns?
Because most beginners don't have the experience, knowledge, or time required to analyze hundreds of companies, understand financial statements, and manage investment risk. Mutual funds allow investors to access a professionally managed portfolio that spreads money across multiple investments instead of depending on the success of a single company.
So what exactly is a mutual fund, and why has it become one of the most popular investment vehicles in the United States for long-term wealth building?
A mutual fund is essentially a collection of money from thousands or even millions of investors. Professional fund managers use that pooled money to buy stocks, bonds, or other assets. Instead of owning shares in just one company, you own a small portion of an entire portfolio, which helps reduce risk and increase diversification.
Does that mean when I invest in a mutual fund, I'm automatically investing in multiple companies at the same time instead of putting all my money into one stock?
Exactly. Depending on the fund, your investment may be spread across dozens, hundreds, or even thousands of companies. This diversification is one of the biggest reasons mutual funds are often recommended to new investors who want exposure to the market without taking excessive risks.
Why is diversification considered such a powerful advantage when it comes to investing and protecting your money over the long term?
Because no company is guaranteed to succeed forever. If you invest all your money in one company and it performs poorly, your portfolio could suffer significantly. Diversification reduces the impact of any single investment and helps create a more balanced risk profile.
Before investing in a mutual fund, what is the first thing a beginner should understand about their own financial situation?
The first step is identifying your financial goals. Investing for retirement requires a different strategy than saving for a house, building an emergency fund, or planning for your children's education. Your goals determine how much risk you can take and which funds may be suitable.
I've heard investors talk about risk tolerance all the time. What does that actually mean in practical terms?
Risk tolerance refers to your ability and willingness to handle market fluctuations. Some investors can remain calm when their portfolio temporarily declines, while others become anxious. Understanding your emotional and financial tolerance for risk is essential before selecting any investment.
Are all mutual funds basically the same, or are there different categories designed for different types of investors and financial objectives?
There are many different categories. Some focus on growth, some on income, some on bonds, some on large companies, and others on specific industries. The best choice depends on your investment goals, timeline, and risk tolerance rather than what happens to be popular at the moment.
Many people online seem obsessed with finding the next stock that will skyrocket. Why do experienced investors often choose mutual funds instead?
Because successful investing is usually more about consistency than excitement. Chasing hot stocks can be risky and emotionally stressful. Mutual funds allow investors to participate in market growth without needing to constantly predict which individual company will outperform next.
If I decide to invest, how do I actually get started without making beginner mistakes that could cost me money later?
Start by opening an investment account with a reputable brokerage firm, educating yourself about available fund options, reviewing costs and objectives, and making sure your investments align with your long-term financial plan rather than short-term market trends.
What are some of the most important factors I should examine before selecting a mutual fund for my portfolio?
You should review the fund's objective, holdings, historical performance, expense ratio, management approach, and overall risk level. Most importantly, You should understand what the fund invests in and why it fits your financial goals.
You mentioned expense ratios earlier. Why do experienced investors pay so much attention to fees when choosing investments?
Because fees may seem small today, but they can significantly impact long-term returns. Money spent on fees is money that is no longer compounding in your account. Over decades, even modest differences in expenses can create substantial differences in final investment outcomes.
Should a beginner focus heavily on a fund's past performance when deciding where to invest their money?
Past performance can provide useful information, but it should never be treated as a guarantee of future results. Markets change constantly, and successful investing requires looking at the overall strategy rather than simply chasing whatever performed best recently.
Is it better to wait until I have a large amount of money available, or can I start investing with smaller contributions?
Many successful investors begin with small amounts and invest consistently over time. Building the habit of investing regularly is often more important than waiting years to accumulate a large lump sum before getting started.
What happens after I purchase shares in a mutual fund, and how does my investment actually grow over time?
Your investment grows when the underlying assets owned by the fund increase in value, generate dividends, or produce interest income. Over time, reinvested earnings and compound growth can significantly increase the value of your investment.
People often talk about compound growth as if it's some kind of financial superpower. Why is it considered so important?
Because compounding allows your investment returns to generate additional returns. Instead of earning money only on your original investment, you begin earning money on previous gains as well. Over long periods, this effect can dramatically accelerate wealth creation.
What are some common mistakes that prevent beginner investors from benefiting fully from mutual funds?
Many beginners panic during market declines, chase recent winners, invest without clear goals, ignore fees, or constantly switch strategies. These behaviors often reduce returns and make investing more difficult than it needs to be.
If the market experiences a major crash, should mutual fund investors immediately sell everything to avoid further losses?
Historically, emotional selling during periods of fear has hurt many investors. While every situation is unique, successful long-term investors typically focus on their plan and avoid making major decisions solely because of short-term market volatility.
How often should someone review their mutual fund portfolio without becoming obsessed with daily market movements?
Reviewing your portfolio periodically is healthy, but constantly checking prices can encourage emotional reactions. Long-term investing is usually more successful when investors focus on years rather than days or weeks.
If someone wants financial freedom in the future, can mutual funds realistically play a major role in achieving that goal?
For many investors, mutual funds have been an important tool for building long-term wealth because they offer diversification, professional management, and exposure to broad market growth while remaining relatively accessible to ordinary investors.
If you could give every beginner investor in America one final lesson about mutual funds, what would it be?
Stop asking how quickly you can get rich and start asking how consistently you can invest. Wealth is usually built through patience, discipline, and time. The people who allow their money to work for them year after year often achieve results that seem impossible to those who never started.